Good morning, friend. Based as question quick, factual anchors, most loaded bearing statements. Gold has surged to record high in 25, driven by geopolitical risk. Center have revised gold forecast sharply. Premia rose. Expectation of US rate cuts and softer real while tariffs and trade tensions added influx confidence and amplifying gold's dollar price move. Gold exporting countries and miners higher prices while importers and consumers face cost pressures. Banks increasing gold holds things shift macro. Your slide deck, the thought economy is ready, friend. The thought economy, who wins when gold keeps rising and what happens to the dollar. 2025 Insight Deck. Slide 1, title and overview. Gold prices have surged to record highs in 2020. US dollar shows signs of structural weakness. Who benefits most and how does the futures look? Slide 2. Gold surge 2025 why and how core insights. Geopolitical uncertainty drives safe haven buying. Central banks diversify away from the dollar. Fed gold. Trade tensions and tariff talk fears. Gold exporting nations enjoy revenue surges, importers face higher costs. Slide 3. 50 strategic questions. Part 1. Questions 1. Value. If banks keep buying, should investors? Are you ready for sharp pullback in a bull trend? Should you separate bullion ETFs, miners, futures? Do you understand the gold dollar link? Will geopolitical stocks keep gold demand high? Be resilience. Should emerging producers diversify profits? Would tips and gold balance inflation risk? Should sovereign bond portfolios test FX? Do you have an exit plan for panic spikes? Are you tracking Fed policy cues if dollar weakens? Corporate FX? Will exporters face fiscal risk post boom? Or liquidity risk in physical holding ignored? Is de-dollarization accelerating reserve shifts? Should real assets rise or miners fundamentals overlooked? Should planting be insured and allocated? Would DCA reduce volatility impact or gold signal is shift? Should corporates test for input spikes? Slide 4. 50 strategic questions. Part 8. Gold exposures. 27. Are you ready for policy risk if sanctions expand? 28. Should tax treatment guide allocation sizes? 29. Do family officers need a separate edge budget? 30th. If dollar rebounds, will you buy gold dips? 31. Are you geopolitical risk in mining ignored? 32. Should you run inflation shock scenarios? 33. Are corporate treasurers building FX buffers? 34. Are central bank gold flow strategic signals? 35. Would long dated options benefit? Define risk exposure. 36. Is multi-assets diversification stronger with gold? 37. Will importers face margin squeezes? 38. Should clients learn gold insurance role? 39. Is intellectual capital part of the new thoughts economy? Hedge. 40. Should weekly data tracking replacing monthly updates? 41. Are volatility hedges? Yes. 42. If dollar weakens is policy driven repo, should pensions adapt to sticky inflation? Is it into mining investments? 46. Will AI based sectors edges inflation naturally? 1. Should gold rich countries diversify revenue? 5. Can policymakers use gold reserves as young investors being educated on gold? 50. Is your portfolio stress tested for shocks? Winners and losers in the thoughts: green for winners, red for losers. Winners: gold miners and exporting countries. Central banks diversifying reserves. Investors with early gold exposures. Commodity ETFs and bullion funds losers. Dollar dependent economies, gold inclinations, inflation sensitive sectors. Consumers facing rising jewelry tech costs. Slide 6. Future forecast happens in the dollar. This is one more 50 sentence question mark. Read as prompts. Checklist questions. If central bank keep buying, should portfolio allocation to bullion be increased gradually rather than all at once? Are you prepared for sharp retracements even during equities and for the future when allocating the gold? Do you understanding how a weaker dollar mechanically pushes demand is unchanged? If tariffs and geopolitical shocks persist, should you expect safe haven demand to remain elevated? Or miners in your portfolio operationally and politically insulated enough to survive a sudden commodity shock or strike? Should emerging market gold producers reinvest windfall revenues in commodity? Would adding inflation protected assets seat? If central banks diversify reserves into the gold, should sovereign bond strategies due to panic rather than fundamentals? Are you monitoring Fed communication closely enough? FX risk more aggressively to protect profit margins would reverse or investors overlooking exposures. If gold is rallying because of de-dollarization or early signals, should financial advisors re-examine clients' currency exposure in cross-border portfolios amid dollar weakness? Would rebalancing schedules tied to emotional decisions when gold leaps? If inflation stays sticky despite Fed easing, should real asset weightings, real estate, commodities, precious metals be nudged, or miners, capex plans and balance sheet prefer allocated volanting and insured storage for meaningful physical position? If you expect gold to remain volatile, would dollar cost averaging reasonable implementation method? Are you tracking the gold or silver ratio to heaven metal demand? Would stress testing corporate earnings for higher raw material and hedging cost? If central bank buying is structural, should sovereign or sanction cycles would re-examine tags for bullion change? How much physical to hold? Should family offices carve out a separate risk budget for currency and if the dollar resumes strength later, do you have buy plan for gold dips? Are you considering miners geopolitical exposure help portfolio resilience? Should non-dollar cash buffers if invoicing or supply chains move across currencies? If central banks reports more gold purchases, should transparency and timing of those flows be treated as strategic signals or long dated options or structured products appropriate to express a view on risk? Would combining gold with real assets and selective equities reduce correlation and improve risk adjusted returns? If you are a consumer import prices due to pricing, bullion and commodity pressures, should advisors educate clients on these psychological pushes? Intangible value creations are you would tracking central banks pieces trade headline? Are you using volatility in miners or bullion ETFs? If the dollar weakens, driven, should global corporates reprice section? Should pension funds revisit liability matching? If are you considering the environmental and social governance? If AI and thought industries infrastructures, education to stabilize future incomes, if you are a policymaker, would they make assets? Finally, will you keep your deeply explained? This is the video.
In October 2025, gold prices soared past $4,000 per ounce for the first time, a landmark moment reflecting deepening global economic uncertainty. This surge has been propelled amid volatile markets and changing fiscal policies. Expectational banks continue to diversify their reserves. These developments underscore the complex interplay between geopolitical events and financial markets. To understand the full picture, let's examine the primary forces driving gold's remarkable rise. Several factors have converged to fuel gold's ascent. Escalating geopolitical risks, especially from US-China trade disputes, have led investors to favor gold's stability. Central banks in emerging markets are actively expanding their gold reserves, with forecasts pointing to sustained purchasing in the coming years. Economic uncertainty, amplified by US fiscal measures such as tariffs and export restrictions, has diminished confidence in conventional and made gold an appealing hedge. These influences are not only shaping gold's appeal, but also impacting global currency markets. Next, let's look at how these trends are affecting the US dollar. As gold continues to climb, the US dollar has experienced a notable decline, losing over 9% of its value against major currencies in 2025. This inverse relationship reflects investors' shifting confidence. As gold becomes more attractive, the dollar's appeal wanes. Concerns about US economic stability and anticipated interest rate cuts have intensified this trend, prompting central banks worldwide to bolster their gold holdings and gradually reduce their reliance on the dollar. While this does not yet signal a complete move away from the dollar, it marks a significant evolution in global currency dynamics. With these changes underway, it's important to consider their implications for investors and the broader financial landscape. The recent surge in gold prices has provided stability for investors and allowed central banks to diversify their reserves, while the US dollar faces increasing scrutiny regarding its status as the world's primary reserve currency. These developments point to a shifting global financial landscape where gold's role as a safe haven is being redefined and economic power balances are evolving. As nations and investors adapt, the future of international finance may hinge on diversification and resilient risk management strategies.
This is thought of economy. How is the future? Future is now drained, mined, gold or dollar, gold or increased, dollar or decrease, or gold, dollar, both are increased. Inverse correlation, gold versus dollar. Economy of thoughts. Thoughts driven economy. Ideas power the world. Future gold prices. Gold's next chapter. What is the next chapter? Gold chapter. Why? How? 2025 gold rush. Who is win? Gold or dollar or other countries? Dollar's uncertain future. Gold economic rain. Fed's gold grab. Fed's declaration. What is gold grab? Gold demand surge. World gold's AI future. Oh, oh. Dollars fall. Gold's rise. Dollars fall, gold's rise. Or gold's fall, dollars rise. What happened? What happened? Please like, subscribe, and positive or negative comment, any comment we will receive. Thanks my dear friends. Thank you very much.